welcome to BloombergQuint. One of the things on the Reserve Bank of India's agenda for the last few years has been a review of the private bank shareholding, ownership, and governance guidelines. There was an internal working group that had come out with a report in 2020, and one of its eyebrow-raising recommendations was that perhaps it's time to allow corporates into banking with some safeguards and amendments to the PR Act. Well, the RBI has now come out with its final guidelines. They have accepted some recommendations and others have been kept on hold for review. They have not accepted the recommendation to allow corporates into banking just yet. Joining us to talk about that is the other recommendations, including a higher motor stake that's been permitted. Ashvin Parekh, a veteran of the banking sector, has seen this debate play out over many cycles. Same for Dhananjay Sinha, who's joining us here today on this conversation. Well, thank you both so much for taking the time to speak to us. Mr. Parekh, I'll come to you first. Do you think they've done the right thing by not taking that big leap of allowing corporates into banking? The experience of the last couple of years have suggested that supervision perhaps is not strong enough for us to take that leap, open the sector up to risks even more than we've seen play out.
No, so look, true. I suppose the internal working group had really come out with, several recommendations. And when I studied them, I could classify them into three broad categories. The first category was where I suppose a lot of requests from the industry in regard, let's say, the shareholding and ownership of private sector banks, that actually including the listing ones. There was a request from the industry, or there was actual difficulty faced by the industry, and this had to be considered. So internal working group had made some recommendations around. So that's the first sort of classification. The second set were a lot of improvements. For example, extending period from, let's say, a certain amount to 8 years and things like those. So that was the second set of recommendations. But the third was a radical one. And the third one is what you were touching up in your discussion right at the beginning. But the third one, at length, discussed the capital requirement in Indian banking. And it laid down an emphasis, suggesting that this capital could come from corporates and large NBFCs, basically. Now, large NBFCs, I thought personally, could have been possibly the first candidate before they would have gone into the corporates, basically, because corporates is a subject which, they've been touching and going. They've been talking about it and not doing it. Say they'll do it, but then they can't do it or they won't do it. So, we started in 1992 and the first set of licenses were obtained. No corporate was admitted. Otherwise, I had actually, assisted in, one of the corporates to put up the application. But then, of course, nobody got it. No corporate got it, sorry. Then 2000, once again, when 2003, Yes Bank and Kotak Mahindra Bank were given the licenses. Once again, we saw that professionals, financial service professionals were given the license, but the corporates were not admitted. 2010, however, there was a lot of pressure from the Ministry of Finance. The Ministry of Finance at that point in time thought that the capital required for funding SMEs, which has been a neglected sector from banking for a while. That has always been the analysis. Most of the analysis or the evaluation suggests that the Indian banking has really not been able to, support the funding kind of requirements of SMEs as much as it is required, basically. And to that extent, it was thought that corporates could really come into that, provide capital, let's say, and then enhance the credit flow. 2011-12, we saw RBI coming out with copious drafts, detailed drafts on what is a business. Business group was defined. They moved away from that concept of corporate kind of, and what is a business group, and things like those. And what were the key essentials for a business group to participate in banking was also thought about. And there were, at that point in time, draft guidelines or draft discussions around that, including the structure issue of NOFHC that came in at that point in time. And I do know, Shamla Gopinath Committee had really come out with those recommendations at that point in time. So, and Usha Thorat Committee had also touched upon the subject of the arbitrage between banking regulations and NBFC regulations and encouraging large NBFCs and corporates to get into. So all that was happening around that time. But then once again, when the licensing happened, we saw only IDFC Bank and Bandhan Bank making to it, which is no corporate was once again admitted, basically. So it's been a touch and go. There is a valid reason because corporates worldwide, it has been observed even in the US, for instance, large corporate groups or business groups are not, they're not encouraged. In fact, they actually kept away from the banking system. So to that extent, I would say the entire recommendation or the work done by IWG, sounds a good exercise. But from the practicality point of view, I think it becomes a little difficult. So my personal take was,
the final vote has gone in the direction of the slave-traded path on this subject, Dhananjay. Do you see this as appropriate, or as Mr. Parekh was saying, one argument has been that there isn't enough capital available, and now as we get into privatization of banks, certainly it's going to be a question who is going to come in and invest in these public sector banks. Could the RBI have taken the lead?
So I think you need to have a more liberal approach in terms of how you allow ownership of the banking sector, given the context that the lending business is actually diversifying with more NBFCs gaining market share, also technology changing. There are multiple types of organizations that are getting into banking business. So I think beyond a point, it becomes kind of facile to really differentiate between a banking entity running purely banking entity running banking business, because there are a lot of non-banking entities who are also getting into banking business. For instance, in NBFC itself, there are many more corporates who are actually getting into that business. So you have a lot of manufacturing sector companies now having good amount of business in NBFCs that are there. There are technology-oriented entities who are into payment banks and stuff. So I think there needs to be a sort of a change in the setup of landscape that is happening. Market shares are actually changing, and you need to have a competitive landscape within the banking sector. So I think at a certain level, the way structural changes are happening, you need to invite private corporates to also be there. And as Mr. Parekh has said, and I think this has been talked about extensively for a long period of time, that for the growth capital will need to come from private corporates. So you need to have a mechanism through which you can allow them entry into the banking system. I think what you require is a far more robust regulatory mechanism. The concern essentially comes from mid 90s, especially the Asian crisis, where we had a lot of asset concentration, the ownership resulting in a sort of funding the same corporates as the owner of the company. So those things are there and very well understood. I think the regulatory mechanism are there which can actually prevent that from happening. And RBI itself has a lot of asset concentration mechanism through which it ensures that asset concentration doesn't happen. There are limits that are there for individual corporates or industry segments. All those things are there. So you need to work around a more robust supervision mechanism, and I think they are working towards that. And I think as you move towards that and sort of adopting the changing landscape of the banking system, I think it is a need for the day that that you require more capital. You can't have governments infusing capital all the time, recapitalizing PSU banks, etc. So for growth, you require such kind of a change, which has not been adopted, I think, in the final document. So
not yet.
I think that's an opportunity missed. Yeah.
Not yet.
I think it's an opportunity missed. Mr. Parekh, any thoughts, any sort of rebuttal on that? My only rebuttal on that is that, practically speaking, if you see what has happened in the last 2 years, when you haven't even been able to manage risks arising out of, say, professional promoters or NBFCs, I mean, you have to sort of, it takes a very brave regulator and a head of a, RBI to say, okay, I'm willing to go in the direction of office. Because once you open it up, then you can't put artificial limits saying I'll give it to X and I won't give it to Y.
Yeah. No, you're so right. In fact, to be very honest, let's say when you look at the corporates, for example, now we know that most corporates will have cyclical businesses. Now, during the time when, let's say, the businesses are not performing, for example, and then, of course, through the leveraging that they do, sometimes they end up picking up a lot of debt themselves, basically. Now, in a situation like that, you would be really placing the deposit holders and the entire banking system to risk. If, let's say, if a promoter had a steel business, we saw steel business is still not been able to recover, for instance, or if he is into something else, for instance, and then the Indian large conglomerates are well diversified also, and the risk can come from any dimension, any direction, basically. So to that extent, for a regulator to continuously watch, as a part of fit and proper, and to say that, look, hey, guy, this guy looked fit and proper just about 5 years ago, but today is not fit and proper on account of his weak balance sheet, overall group balance sheet, the pockets are withdrawn. I mean, those aspects become difficult for a banker and for a central banker. So to that extent, I would say it's better to sort of keep some kind of firewall between sort of I touch upon Dhananjay's point, and he raised a very interesting point. Credit flow from that perspective, the large NBFCs are really providing. So if I really analyze the large NBFCs who are above 50,000 crores, for example, their total asset book, then in that case, only 2 or 3 out of the 7 or 8 which are there, they say are really professionally, financial service professionally kind of managed. The others are from corporate houses, let's say. And the corporate houses, and some of them are also deposit-taking NBFCs for that matter. So to that extent, let's say they have a role to perform. As long as the RBI removes the arbitrages between the banking kind of, let's say, entity and an NBFC, but yet continue them as NBFCs, for instance, let's say, then, I'm not seeing anything particularly wrong in that model. I thought that by way of at least some experiment, the regulator could possibly look at least the professionally managed large NBFCs, and you have 3 or 4 which are substantially large. They could be brought into the banking system to begin with.
Just to clarify, so they have said that if, in terms of conversion, so they've said NBFCs with 10-year time frame can look for a conversion. Now, whether they'll allow the large corporate house-owned NBFCs to, fit into that conversion bucket or not, time will tell. But as a rule, they've said 10 years and you can apply.
But that's not all, to my mind. You see, I'll tell you, where is the real line drawn? The real line is that there is 7 or 8 sets of dispensations, including the SLR requirement.
Yeah.
Which are so essential. How can you really imagine, the first 3, which are first 1 or 2 entities, let's say, the size of the SLR requirement would be so substantial, unless some dispensation is really provided. Then there is another aspect also, which cannot be ignored here, and that is, let's say, these people have very subject-specific kind of lending. So let's say someone could be in housing finance, someone could be in transport finance, some could be, something else. Now, then if they have to migrate to become a universal bank, with priority sector lending and with other requirements, unless, of course, something gets classified as priority sector, vehicle finance can get priority sector kind of lending. But these are the complications. So without those clarifications or dispensations, it is not. Now, when I talk about this, my mind goes back to all the possible dispensations that, let's say, the regulator may have provided to IDFC to become a bank. If they could even do it on a case-to-case basis, for that matter, study 2 or 3 NBFCs who really require to become banks, for example, by their sheer size.
Yeah.
And I know that one of the clarifications that they rendered recently was that even if they do come out with guidelines, there will be guidelines for fitting for everybody. Then they'll not make exceptions, because otherwise the regulator will be, be asked to justify. So, they want to keep away from that kind of an approach, let's say. That I appreciate. But I would say even then, from the experiment point of view, they could still look at sort of,
they could start sort of looking beyond the tried and tested promoters of banks, perhaps.
Exactly. And then these are not corporates, I mean, in the sense.
Yeah.
So to that extent, let's say they could possibly look at them.
Let me just move to the other issue, which you actually highlighted first, and I'll go to Dhananjay for a bit. So they have said that the maximum, and this will perhaps have the impact on listed entities to some extent, that the maximum promoter stake permitted is now 26% and not 15% as it was earlier. And they have said that even existing banks where the promoters had reduced their stake to below 26% can now come back up to 26%. Do you see this having, a set of entities being impacted by this, Dhananjay?
Yeah, so I think there are a lot of small banks who have actually who can get exposed to this or can benefit from this. I think there has been episodes where there has been a sort of a debate or sort of a change in difference in opinion with a large private sector bank and the RBI, and it went through court proceeding, etc. And there are a lot of discussions on what classifies as core capital and stuff. So I think it had been lingering on for several years, almost like 4 or 5 years. I think this will put a lid to that. And I think what RBI is also trying to do is to clarify what classifies as core capital, what are not. So there are sort of contradicting elements over there. So there is some ironing out of those issues. And I think with this with a higher limit of 26%, I think this whole inconvenient tussle that had been happening will be put to rest. And I think even for smaller banks, with 26% holding, my own sense is that it also shows a more serious involvement of the promoters in running the business and profitably and efficiently, etc. Versus, let's say, if you are 15% or lesser, I think it's a good thing according to me. I don't know what Mr. Parekh has a view. So there are a lot of views around it. I'm sure there was some basis on which 15% limit was there earlier. But I think with a 26% kind of a thing, with a small bank, private sector banks, I think it means that the promoters will be more seriously involved, engaged in running the business.
Dhananjay didn't name the bank, but I'll do it. Mr. Parekh, there is a stamp of the Kotak dispute in 3 forms in these news. Number 1, they have agreed to 26%, and the argument that in any case, voting cap was at 26%, so you're aligning economic rights. 2, they have said here on the term paid up voting equity share capital will be used harmoniously across all of RBI's guidelines and rules. And 3, they have said that from here on, any change that happens in a new licensing round will apply to earlier licensed entities as well. I think there is a Kotak stamp on all of those 3 decisions, no?
Well, actually, there is a little more than that. I mean, of course, you're right, and it starts with that. But I think it's a little more, and it's a positive one. I mean, I totally subscribe to Dhananjay's view of commitment of the promoter, but there's something else as well. Let's say if a promoter is successfully running a banking company, for instance, and he may be a professional, or he may be, but if he is running the bank and in a very sort of, successful way, then for the other shareholders to disrupt that by way of stopping him from making special resolutions, for instance, because there you need at least 3/4 of the shareholders to really vote in favor of any special resolution. So I suppose this 26% is somewhere, whether it's for insurance sector or it is for banking sector, it's a magic number, And
why though?
So I suppose it draws its sort of, this thing from the Companies Act, I suppose, or the provisions of this special resolution, sort of, And personally, I subscribe. Personally, I say there's nothing wrong. It may be bearing sort of Kotak stamp on it, but at the same time, the arguments that were put forth at that point in time were very valid. As long as the entity is not creating any systemic challenge, and if it is managed, so the way exactly a bank should actually be managed, I see nothing wrong with that. I mean, personally,
Okay. Dhananjay, one sort of relatively smaller issue, but relevant from a listed entity's perspective. So I think the RBI is sort of tightening the screws on pledged shares of promoters, in the sense that they're saying that if the pledging of shares pulls them down, they're holding down below what is required by the RBI. That's in the first 5 years, 40%. That's disallowed. They've also said that there's going to be a new mechanism to monitor that, and if pledging goes above the 5% voting cap point, then RBI has to approve. That is again a lesson from the Yes Bank case, and it probably adds to the safeguards that SEBI has.
Yes. So I think that's. I mean, the regulator also learns from the mistakes and stuff, and it's good that these things are incorporated. I think the stability of the bank in a context where there is a reckless pledging that happens can be a risk to the stability of the bank and core capital of the bank. And I think it ensures that if there are promoters who have reasonable stake, let's say about 26% or more, the stability of the capital is ensured, and the seriousness of business is also ensured, because the promoter takes his capital is more responsibly allocated in the bank. So, in terms of the minority shareholders also, it gives a certain amount of stability. So, it's overall, it's good for the, banking capital, the bank's capital, I would say, and eventually the running of the business. I mean, it's a good thing, actually.
I'll stay with you for one more question, and then I'll get to Mr. Parekh on the same issue, on this whole non-operative financial holding company. So they have clarified that while that remains the preferred structure, it'll only be mandatory in cases where the promoter or the promoting entities have other group entities. So I think that has been now quite easily understood, because even in the case of small finance banks, the RBI has allowed them to collapse the operating, the holding company and the operating entity when there is no other business. So now they're saying even for universal banks, it'll only be mandatory if the promoters have other non-banking businesses. Do you see any impact on the listed space at all?
Not really. I mean, I think it's a good structural, it's a alignment to a good structural mechanism, so that other businesses are separated and they're running separately. So it's a good you're ring fencing the banking organization. So it's a good structural change.
I think you're just making it mandatory only when there are other businesses. Mr. Parekh, that makes sense to you?
See, I'll tell you once again, it makes tremendous sense. But let's say it's something that, RBI created, and now they are clarifying. So once again, if you go back to, let's say, the preamble to that, it all started with the first acceptance that corporates could come in. And then you had this question of risks and liabilities from the other businesses getting into the bank. And therefore, this NOFHC kind of a structure was thought about, let's say. Now, if the corporates are not likely to be there, let's say at all, as yet, at least, the further guidelines will explain what's going to be the situation and regard that recommendation of IWG. But if it's not the case, then to that extent, let's say in case of existing companies, I suppose because the risk cannot flow to the bank, that's something that is ensured. Then the need for that structure is just not there at this point in time. Now, if for any reason, a financial conglomerate, not just let's say an NBFC or a bank, but a conglomerate with several financial service businesses, let's say if he were to seek a banking license, then to that extent this NOFHC will once again become relevant, because then the risk can flow from either their insurance business or, so not a bank holding an insurance, I'm not talking about that, but I'm talking about the structure under which the liability can flow back to, to a bank. Exactly. So in such a case, NOFHC could really make a lot of sense. there also, once again, let's not forget, I mean, when you talk about structural changes, Veera, particularly in case of listed entities, to make those structural changes is a very, very difficult, because then you will have to really get into explaining it to each and every retail investor why you are changing that So, I mean, I'm sure the regulator would have been very mindful of the fact that that structural requirement is only applicable where the liability or the risk can flow from the other activities of the promoter into the bank, I suppose. As far as the existing organizations or existing banks, whether they are private sector banks, small finance banks, in each and every case, RBI has examined that aspect and then decided. So, for example, in IDFC, they did create a holdco, for example, let's say. And then there was this question about grandparenting the balance sheet and things like those. So that was essential. And then the regulator actually did the right thing there. But just to contain the risk more than anything else. I mean, any risk in infrastructure business getting into the bank, for instance, let's say. But that's all a matter of past now. For the new proposed entities, this principle is a valid one. Wherever, let's say, there is any scope of any risk or liability floating into the bank or flowing into the bank on account of different activities, I suppose such firewalls are essential.
I'll come to the capital part, which you actually flagged off first, Mr. Parekh. They have raised the capital requirement for new universal banks to 1,000 crore from 500, and I think 300 from 200 for small finance banks. For universal banks, that's a large jump. Again, going to Dhananjay's point that there is not enough diversity in the banking system. By raising the capital to 1,000 crore, do you limit that pool even more?
Yeah. No, so, I mean, I would say let's look at, universal banks at the moment. All of them have this requirement. I mean, all are meeting this requirement. So we're not talking about the new one. The old ones, the existing ones. We're just talking about the new ones. Now, when it comes to the new universal banking entities, one of the thoughts is, and there's something whenever a client has approached me, I've said, that unless you are capable of showing at least about 2,000 to 3,000 crore worth of liquid capital that's available to you, don't even think of forming a new universal bank, basically. Because 500 crores does not give a bank a stability. Even for that matter, 1,000 crores. And automatically, if the Basel and the capital adequacy requirements are met with, when the book size grows beyond a certain point, then automatically the promoter is required to bring in that amount of capital or raise that kind of capital in the market. That's one of the two. So to that extent, as an entry point, 1,000 crores is not a very bad idea at all. The only problem is how many universal banks are we really talking about? So my mind goes back to a point where if, let's say, Shamla Gopinath committee was offered 4 universal bank applications, and I think 3 or 4 small finance bank applications. This particular, let's say, regulation may perhaps have been designed in view of those applications more than anything else, because then now those are the regulations that are applicable. So,
I think they have specified, I'm not absolutely certain, but I think they've specified in this set of rules that these will be applicable to those who apply for a license after these rules have been issued. But I'm not clear. Honestly, I don't know whether it'll apply to those pending applications or not. But Dhananjay, do you see 1,000 crore as a reasonable amount of capital, given what you know about the kind of capital existing entities run with?
So what does it do is to really ensure that the banks that are giving licenses, they are at a reasonable level of business. So essentially, the capital is a sort of a multiplier thing for the total asset that you run. So basically, with a higher capital that you are actually requiring, you're basically saying that you need a sizable business for an entity to look for a banking license, which is a good thing in the sense that we are actually looking at size. So typically, if you look at a minimum capital requirement of 8%. So you're looking at something like 12, 13 times of leverage. So, so you're looking at a reasonable size of asset book. So I think it gives a good level of takeoff level from where banks can actually grow, rather than having small banks which will struggle. So I think growing the banking business is a tough job, especially the universal bank, wherein you have to really invest in developing retail business, on deposit franchise, etc. Of course, you have technology now which can help, but it's a kind of a marathon. It's not something that you can actually sort of multiply in a very short period of time. We have seen small banks actually finding it difficult, especially in the retail space. So I think you need to have a reasonable threshold for banks to sort of have entry and then grow. We do not want, I mean, it will be appropriate for banks to really get into the space and grow in a reasonable, healthy manner. So you need to have a reasonable size. I think this enlargement of capital requirement is a right thing to do. Possibly it can be more, as Mr. Parekh is hinting. So I think it's a right thing to do, I would say.
I have a little bit of time left. Mr. Parekh, I have two short questions for you, and jump in. One of them is actually very specific. So I think, on the conversion of payment banks to small finance banks, the IWG had recommended that even after a 3-year period, payment banks can, convert to a small finance bank. But the RBI has not gone with that. They've said that it should be 5 years. That's prudent, I think, given the nature of entities that got the payment bank licenses.
See, I mean, those were, let's say, payment bank licenses, and we already got the approval to become small finance banks, for example. We already got one example of that. So, let's say, in such cases, after 5 years, that is, in such cases, I mean, you will agree with me that, let's say, I mean, and this was applicable to even microfinance companies which became small finance banks, that the credit sort of and the capacity on one side, and the B is the ability to assess and the ability to really monitor and a book of larger size, for example, compared to, is a complicated one. Now, in case of payment banks, there are two issues. One is the size of deposits itself, there is a limitation there. So now you're really going to raise more deposits if you become a small finance bank from a payments bank. And the other one is, of course, the loan book, because you are constructing a completely fresh loan book, and therefore creating the capacity for that. Unless your payment bank itself is a stable entity, to dream of a small finance bank is a bit of a challenge. So, I mean, my mind goes to, let's say, the Department of Post kind of an environment, for instance, let's say. Now, it could pose a systemic risk, for example, only if it was, I mean, it got into something which was a little too premature for it, sort of, So, to that extent, I mean, I would certainly say that this 5-year period is not a bad idea. And during this 5 period, I mean, because a payment bank would take anywhere between 3 to 5 years to stabilize also. First 3 years, it is struggling actually. So, because it's totally service fee kind of we are talking about, there's no loan book interest, net interest income to be earned or whatever stuff. So, to that extent, it's a complicated subject, I mean, I would say. I would have gone to the extent of saying that if you really did believe in differential banking, then why even open a path for payments bank to become small finance banks? I don't know. I mean, the promoters can go for a fresh license for a small finance bank, but I mean, migrating a payments bank into a small finance bank is a little difficult subject to my mind, basically.
Actually, I'll leave it there. Ms. Parekh, Dhananjay, thank you so much for joining us here. Appreciate you taking time to speak. Thanks for watching.
Thank you. Thanks.